Look, something extraordinary is happening right now in the currency markets, and most people have no idea they're watching history unfold in real time. The dollar, the world's reserve currency for over 80 years, is facing a reckoning that's been building for decades. And gold? Gold is doing something it's only done a handful of times in modern history. Let me show you what I'm seeing, because the data tells a story that should concern every person holding dollars right now. Gold just crossed $4,000 per ounce. Think about that for a second. In October, we watched it breach this psychological barrier that seemed impossible just a few years ago. But here's what's really fascinating. This isn't just another bull run. This is different. The price has doubled in less than 2 years, and the buying pressure isn't coming from where you'd expect. Central banks around the world purchased over 1,037 tons of gold in the most recent year on record. That's the third consecutive year they've bought more than 1,000 tons. To put that in perspective, that's roughly 33 million ounces. At current prices, we're talking about $132 billion worth of gold being accumulated by central banks alone. But who's buying? That's where this gets interesting. China's central bank has been on an absolute tear. They've been adding to their gold reserves month after month. And here's the thing. Most analysts believe they're reporting only a fraction of what they're actually buying. Why would they do that? Because if the world knew the true extent of their accumulation, it would send gold prices even higher before they finish building their position. The People's Bank of China isn't stupid. They're playing the long game. Russia, India, Turkey, Poland, Singapore, the list goes on. These aren't small players. These are major economies making a calculated decision to move away from dollar-denominated assets and into physical gold. They're not doing this because they hate America. They're doing this because they see what's coming. And what's coming is a fundamental shift in how the world conducts trade and stores wealth. Let me take you back to 1971 for a moment, because history doesn't repeat, but it sure does rhyme. August 15, 1971, President Nixon closes the gold window. The dollar is no longer convertible to gold. The Bretton Woods system collapses. And what happened next? Gold went from $35 an ounce to $850 by 1980. That's a 328% increase in less than a decade. But here's what most people forget about that period. It wasn't just about gold going up. It was about the dollar losing purchasing power at a rate that destroyed the savings of an entire generation. People who thought they were being responsible by keeping their money in savings accounts watched their wealth evaporate in real terms. The official inflation numbers said one thing, but anyone buying groceries or paying rent knew the truth was far worse. Now, I'm not saying we're in an identical situation. The world is different now. But the underlying dynamics? Those are eerily similar. We've got massive government debt, central banks printing money at unprecedented rates, and a growing number of countries actively working to reduce their dependence on the dollar. Let's talk about what's happening with the dollar itself, because this is where things get really concerning. The dollar index, which measures the dollar's strength against a basket of major currencies, has been showing weakness. But that's not the full story. The real story is happening in trade settlement. More and more international transactions are being conducted in currencies other than the dollar. China and Russia are settling oil trades in yuan and rubles. India is buying Russian oil in rupees. Saudi Arabia, the cornerstone of the petrodollar system, is now accepting yuan for oil sales. Think about what that means. The petrodollar, the system that's underpinned dollar dominance for 50 years, is being dismantled piece by piece. And it's not just oil. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several new members, are actively developing alternative payment systems. They're creating infrastructure that allows them to trade without using dollars. They're building a parallel financial system. Why does this matter to you? Because every time a trade happens outside the dollar system, that's one less source of demand for dollars. And when demand for something decreases while supply increases, well, basic economics tells you what happens to price. The Federal Reserve's balance sheet exploded from under $1 trillion before 2008 to over $8 trillion at its peak. That's 8 times more dollars in the system. Sure, they've reduced it somewhat, but we're still sitting at levels that would have been unthinkable 20 years ago. More dollars chasing the same amount of goods and services. That's the textbook definition of inflation. But here's where gold comes into the picture in a way that's absolutely critical to understand. Gold isn't just going up because people are scared. Gold is going up because it's repricing itself against a devaluing currency. When central banks buy gold, they're making a statement. They're saying, we don't trust the current system to preserve our wealth. And these are the people who run the system. Let that sink in for a moment. The very institutions that manage monetary policy, that set interest rates, that control the money supply, they're buying gold. What do they know that the average person doesn't? They know that every fiat currency in history has eventually failed. Every single one. The dollar has lost over 98% of its purchasing power since the Federal Reserve was created in 1913, and the pace of that decline is accelerating. Look at what's happened to prices in just the last few years. Housing, food, energy, healthcare, education, everything is more expensive. Your paycheck might be bigger, but it buys less. That's not inflation in the traditional sense. That's currency devaluation. And gold is the canary in the coal mine. When gold starts moving like this, when it breaks through major resistance levels and keeps climbing, it's telling you something about the underlying health of the currency system. It's a warning signal that's been reliable for thousands of years. Now let me show you something that most people miss when they look at gold prices. Gold isn't just hitting new highs in dollars. It's hitting new highs in euros, in yen, in pounds, in virtually every major currency. That tells you this isn't just about the dollar. This is about a global loss of confidence in fiat currency as a whole. But the dollar is the reserve currency. It's the one that matters most. And when the reserve currency starts losing credibility, the implications are enormous. Think about what happened in Weimar Germany. Think about Zimbabwe. Think about Venezuela. These are extreme examples, but they all started the same way. Governments spending more than they could afford, central banks printing money to cover the deficit, and a slow erosion of confidence that eventually became a stampede. We're not there yet. Not even close. But the trajectory is concerning. The U.S. national debt is over $36 trillion. The interest payments on that debt are now one of the largest line items in the federal budget. We're borrowing money just to pay the interest on money we've already borrowed. That's not sustainable. And here's the kicker. There's no political will to fix it. Neither party is serious about reducing spending. They argue about the details, but the trajectory is always the same. More spending, more debt, more money printing. The bond market knows this. That's why yields have been volatile. That's why foreign buyers are reducing their holdings of U.S. Treasuries. They're looking at the same numbers we are, and they're making rational decisions to protect their wealth. And they're buying gold. Let me tell you about something that's happening right now in the physical gold market that should concern every investor. The premiums on physical gold, the amount you pay above the spot price to actually get your hands on real metal, have been elevated for months. In some markets, you're paying 5%, 8%, even 10% over spot just to get delivery. That's not normal. That tells you there's a disconnect between the paper gold market, the futures and derivatives that trade on exchanges, and the physical market where real metal changes hands. And when that disconnect gets too large, something has to give. History shows us that when push comes to shove, physical always wins. Paper promises are only as good as the institution making them. Physical gold in your possession? That's real wealth that can't be printed away or defaulted on. The COMEX, the major exchange where gold futures trade, has a ratio of paper claims to physical gold that's staggering. Some estimates put it at 100 to 1 or higher. That means for every ounce of physical gold in the vaults, there are 100 ounces worth of paper claims. What happens if even a small percentage of those paper holders decide they want physical delivery? The system breaks. It's that simple. We saw a glimpse of this during the chaos of recent years when premiums spiked and delivery delays stretched to weeks or months. That was a warning shot. The next time it happens, it might not resolve so easily. And speaking of physical gold, let me mention something quickly because it's relevant to a lot of people watching this. If you're sitting on a significant retirement account, $100,000 or more, you might want to look into how gold IRAs work. I put together a free guide that covers the basics, how to get physical gold into your retirement account without triggering tax penalties, what the rules are, that sort of thing. It's in the description if that's something you want to explore. No pressure, just information. All right, back to what's happening in the markets right now. The technical picture for gold is incredibly bullish. We've broken through every major resistance level. The 50-day moving average is above the 200-day, a classic golden cross pattern. Momentum indicators are strong. And perhaps most importantly, we're seeing consistent buying on dips. That last point is crucial. In a real bull market, pullbacks get bought aggressively, weak hands get shaken out, and strong hands accumulate. That's exactly what we're seeing. But the fundamentals are what really matter here, and the fundamentals are screaming that we're in the early stages of a major repricing event. Let's talk about supply and demand, because this is where things get really interesting. Gold mine production has been essentially flat for years. It's incredibly difficult and expensive to bring new mines online. The easy gold has been found. What's left requires massive capital investment and years of development. Meanwhile, demand is surging. Central banks are buying at record levels, as we discussed. But it's not just central banks. Retail investors in Asia are buying. Institutional investors are allocating. Even some of the big hedge funds that traditionally ignored gold are starting to build positions. And then there's the industrial demand. Gold isn't just a monetary metal. It's used in electronics, in medical devices, in aerospace. As technology advances, industrial demand for gold continues to grow. So you've got flat supply and surging demand. Economics 101 tells you what happens to price. But there's another factor that most people don't consider: the cost of production. The all-in sustaining cost for gold miners, the amount it costs to pull an ounce of gold out of the ground, including all expenses, is somewhere around $1,300 to $1,500 per ounce for most major producers. That's the floor. Gold can't stay below that level for long without mines shutting down. But here's what's interesting. As gold prices rise, it doesn't necessarily mean miners become wildly profitable. Why? Because their costs rise too. Labor, energy, equipment, everything gets more expensive in an inflationary environment. So the gold price has to keep rising just to maintain margins. It's a treadmill effect that actually supports higher prices over time. Now let me show you something that connects all of this together in a way that should make the hair on the back of your neck stand up. The velocity of money, the rate at which money changes hands in the economy, has been declining for years. That's deflationary. But at the same time, the money supply has been exploding. That's inflationary. These two forces have been in tension, and so far, the deflationary force has been winning in some sectors while inflation has been raging in others. But what happens when velocity picks up? What happens when all that money that's been sitting on the sidelines starts moving through the economy? That's when you get real inflation, not the 3% or 4% we've been seeing officially. I'm talking about double-digit inflation that destroys purchasing power in real time. And when that happens, gold doesn't just go up, it explodes. Look at what happened in the 1970s. Inflation hit double digits. Gold went from $35 to $850. People who owned gold preserved their wealth. People who didn't saw their savings evaporate. The same thing happened in other countries during their currency crises. In Turkey, in Argentina, in Lebanon, gold in local currency terms went parabolic while the currency collapsed. I'm not saying the dollar is going to collapse tomorrow, but I am saying the conditions are in place for a significant devaluation over the coming years, and gold is the traditional hedge against exactly that scenario. Here's something else that's happening that most people aren't paying attention to: the changing nature of global trade. For decades, the system worked like this. Countries would export goods to the United States, receive dollars in payment, and then use those dollars to buy U.S. treasuries. This created a circular flow that supported both the dollar and U.S. government debt. But that system is breaking down. Countries are still exporting to the U.S., but they're not buying treasuries at the same rate. They're diversifying. They're buying gold. They're buying other currencies. They're investing in infrastructure and commodities. The circular flow is breaking, and that has profound implications for dollar strength and interest rates. If foreign buyers aren't soaking up treasury issuance, who is? The Federal Reserve, through quantitative easing. But that's just printing money to buy government debt. It's monetizing the deficit. And that's exactly how currency crises start. Now, I want to talk about something that's been bothering me, because I think it's important for people to understand the difference between price and value. Gold's price in dollars is going up, but gold's value, its purchasing power in terms of real goods and services, that's relatively stable. What's changing is the dollar's value. An ounce of gold has always bought roughly the same amount of stuff. In Roman times, an ounce of gold would buy a nice toga and a pair of sandals. Today, an ounce of gold will buy a nice suit and a pair of shoes. The purchasing power is similar. But look at what's happened to the dollar. A dollar in 1913 had the purchasing power of about $31 today. That's a 97% loss of value. And the pace of that loss is accelerating. So when you see gold at $4,000 per ounce, don't think of it as gold getting more valuable. Think of it as the dollar getting less valuable. Gold is just the measuring stick that reveals the truth. And that truth is uncomfortable for a lot of people because it means everything they've been told about saving money and being responsible is based on a flawed premise. You can't save your way to wealth in a depreciating currency. You have to own assets that hold their value. Real estate, stocks, commodities, and yes, gold. These are the things that preserve wealth over time. Cash is a wasting asset. Let me tell you a story that illustrates this perfectly. In 1971, the average house in America cost about $25,000. Gold was $35 per ounce. So a house cost roughly 714 ounces of gold. Today, the average house costs about $400,000. Gold is $4,000 per ounce. So a house costs roughly 100 ounces of gold. In dollar terms, houses have gotten much more expensive. But in gold terms, houses have gotten cheaper. That's because the dollar has lost so much purchasing power that it takes more dollars to buy the same things. Gold has maintained its purchasing power. The dollar hasn't. And this is why central banks are buying gold. They understand this dynamic. They know that holding dollars means holding a depreciating asset. Gold is the alternative. Now let's talk about what happens next, because this is where things get really interesting. We're at a critical juncture. The dollar is facing pressure from multiple directions. Massive debt, money printing, loss of reserve currency status, geopolitical tensions, all of it coming together at once. Gold is responding by breaking out to new highs. But here's the thing. We're still in the early stages of this move. Most retail investors don't own gold. Most financial advisors don't recommend it. Most portfolios have little to no gold exposure. When that changes, when gold becomes a mainstream asset that everyone wants to own, that's when prices really take off. We saw this in the late 1970s. Gold went from $200 to $850 in just a couple of years as retail investors piled in. We could see something similar, but starting from a much higher base. If gold goes from $4,000 to $10,000, that's a 150% gain. Is that possible? Absolutely. Is it guaranteed? Of course not. But the setup is there. The fundamentals support higher prices. The technicals support higher prices. The sentiment is shifting. All the pieces are in place. And here's the thing about gold. It's not just about making money. It's about preserving wealth. It's about having a form of money that can't be printed, that can't be devalued by government decree, that has held its value for thousands of years. In times of uncertainty, in times of currency instability, in times when the financial system is under stress, gold is the ultimate safe haven. It's the asset that's no one else's liability. It's the asset that's survived every empire, every currency, every financial crisis. The Romans had gold, the Egyptians had gold, the Chinese dynasties had gold, and they're all gone. But gold remains. That's the power of gold. It outlasts everything else. Now I want to address something that skeptics always bring up. Gold doesn't pay interest or dividends. It just sits there. That's true. Gold is a store of value, not an income-producing asset. But here's the counter-argument. In a world where real interest rates are negative, where the interest you earn doesn't keep up with inflation, income-producing assets are actually losing value in real terms. If you're earning 2% interest, but inflation is 4%, you're losing 2% per year in purchasing power. That's not wealth preservation. That's wealth destruction. Gold doesn't pay interest, but it also doesn't lose value to inflation. In fact, it tends to gain value during inflationary periods. So the lack of yield isn't a bug, it's a feature. And let's be honest, in the current environment, with interest rates where they are and inflation where it is, the real return on most fixed income investments is negative anyway. You're paying for the privilege of lending your money. Gold doesn't have that problem. Let me show you one more thing that I think ties all of this together. The ratio of the Dow Jones Industrial Average to gold, the number of ounces of gold it takes to buy the Dow, has been in a long-term downtrend since 2000. In 1999, at the peak of the dot-com bubble, it took 44 ounces of gold to buy the Dow. Today, it takes about 10 ounces. That means gold has massively outperformed stocks over the past 25 years. And we're likely not done. Historically, this ratio bottoms somewhere between 1 and 5. We're at 10. That suggests either stocks have a lot further to fall, or gold has a lot further to rise, or some combination of both. My bet? Gold continues to outperform as the currency devaluation story plays out. And here's why I'm confident in that view. The problems facing the dollar aren't going away. The debt isn't going away. The money printing isn't going away. The geopolitical tensions aren't going away. These are structural issues that will take years, if not decades, to resolve. And during that time, gold will continue to serve its role as the ultimate store of value. So, what does all of this mean for you? It means you need to think seriously about how you're protecting your wealth. If all your assets are denominated in dollars, if you have no exposure to hard assets like gold, you're taking on currency risk whether you realize it or not. Diversification isn't just about owning different stocks, it's about owning different types of assets, including assets that aren't someone else's liability. Gold is that asset. It's been that asset for 5,000 years, and it will continue to be that asset long after we're gone. The turning point for the dollar is here. The signs are everywhere if you know where to look. Central banks are buying gold at record levels. The dollar's role in global trade is diminishing. Debt levels are unsustainable. Money printing continues. And gold is responding exactly as it should, by repricing itself against a devaluing currency. This isn't a prediction. This is what's happening right now, in real time. The question isn't whether the dollar will continue to lose purchasing power. The question is how fast and how much. And the answer to that question will determine whether gold goes to $5,000, $10,000, or higher. But here's what I know for certain. The people who own gold will be better positioned than those who don't. The people who understand what's happening will preserve their wealth. The people who ignore the warning signs will pay the price. History is clear on this point. Every time a reserve currency has lost its status, every time a government has debased its currency, every time inflation has spiraled out of control, gold has been the asset that preserved wealth. This time won't be different. The dollar is facing a reckoning. Gold is winning. And the turning point is here.